The S&P 500 fell 45 points today, the fifth loss in the past 7 trading sessions. 2 new lows in the Nasdaq. Did we hit new lows elsewhere? Are we into more bearish technical indicators than we've seen before? Are we headed towards a breakdown of that key 2600 level? Which one do we break first, 2800 or 2600? So I'm going to break down the posture today as compared to what we were expecting on Friday after today's decline to see how that's changed. We're also going to look for a bearish trade idea in the sector that led us down to the downside the most. So let's go ahead and get started. Today is Monday, November the 19th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's get right to today's move on the market forecast indicator. We'll look at the S&P 500 first. There's our reversal pattern almost to Thursday's low point. Not quite down to that low point, but getting relatively close. And we talked about the potential since we dropped so low in the near-term pullback that the idea of us getting up to new near-term highs was the odds were lower, and that in the meantime, in the short term, to expect some near-term ups and downs, we didn't even get up to 2,800. So we already got this near-term pullback here. Now, granted, the near-term line's not below 50 yet, so we'll see if there's any follow-through tomorrow. Even if there's not a new low tomorrow, if there's a smaller range and we stay towards the lower end of this tomorrow, then that near-term line's got a really good chance of getting to the lower half of the chart, and that would be a bearish high point, a lower high in the chart, a high that did not get above 80. That would be bearish. All right, and then of course this is the last near-term low, so really good chance that we'd get down to a lower low. But if we were to get back up towards today's highs tomorrow, and any kind of bounce, then most likely the near-term line will stay in the upper half of the chart. So keep that in mind that it's not below 50 yet. This has the look of a potential bearish near-term high point, but isn't there yet, right? And we're still in the Fibonacci retracement zone. We basically went from the upper end to the lower end of this Fibonacci retracement zone of this initial near-term rally. So we're not out of the woods. We weren't out of the woods to the upside Friday. We're not out of the woods to the downside today. So we're still kind of stuck in this zone area. Obviously, the bearish posture with the intermediate line falling. So we still got the dark pink shading and the market sentiment still falling in the lower half of the chart. Dow Jones Industrial Average, you can see, doesn't look, didn't get quite to the low point. The near-term line's still in the upper half of the chart. You notice the momentum line's not extremely low for either one, but of course is not forming a confirmation, intermediate confirmation signal either, because we don't have a bullish posture on either of these charts. But at least it's not to an extreme low. The Nasdaq's a little different story. Sorry about that. It is closer to an extreme low, to the 6th percentile, but remember it's got a higher beta anyway, and you're going to get those. It did come down to a lower near-term low point. N is back in the lower end of this Fibonacci retracement zone. So it's the one that's been the weak, it's the weak area of the market right now, these tech stocks. Hasn't broken below the low point of that long lower shadow on the weekly chart from a few weeks ago. But definitely something to keep an eye on. The Russell 2000, which is going to look similar to the Nasdaq, because the Nasdaq composite has a big small cap feel to it. It again looks like the S&P and the Dow. The near-term line pulled down, but not below 50 yet. Oversold momentum line, but not extreme. And we didn't get below this prior near-term low point. It's only the Nasdaq where we have. So we'll see if this ends up being, we did pop down to the lower end of the Fibonacci retracement zone here as well, but not to a new near-term low. So tomorrow is kind of an important day considering how, we were looking for some near-term choppiness, ups and downs, before we finally broke through that high point. Considering where volatility is at, you'll see here in a second, we're getting it, right? We got it today. And is there going to be follow-through tomorrow, or is there going to be a bounce tomorrow? That's going to be your biggest question, because right now you're essentially at an inflection point for a lot of these indexes. Unlike the Nasdaq, which has broken below those lows, the others haven't, and that's what you expect these lows to hold until they don't. And again, the shorter the term the lows, the less likely they are to hold, but still you expect them to hold until they don't. and so we're at this inflection point where they are these near-term lows have a chance of breaking, right, and forming a bearish near-term high and going down and retesting these October low points. And we'll find out tomorrow. Now, granted, Wednesday is going to be a relatively big news day from an economic standpoint, but usually is a quiet volume day. So, considering the holiday week and the low volume, don't put a lot of stock into the low seasonal volume, right? The low typical volume that you get. Not that we had low volume today, but the low typical volume you get on the Thanksgiving week with basically 3.5 days of trading. Don't put a lot of stock in either direction, right, to the upside or the downside, but don't put a lot of stock into low volume moves until next week when you have the normal volume kicking back in again. Alright, before we look at some other charts, a reminder to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of the video. Hit that red subscribe button that pops out. Also, click the thumbs up icon down below the video. That tells me, number one, that you got something out of the video tonight. Number two, you want us to do it again tomorrow. Really quick, easy, one-click way to give us feedback. You can do that right now while you're watching. Also, further down below, comment on anything that stood out to you tonight from tonight's video. Join our daily market outlook email list. There's a link popping out in the top right corner of your screen. Click that link up there to subscribe to our list. It contains watch lists of stocks that are showing overbought and oversold clusters on our market forecast, on the market forecast indicator. Also, follow me on Twitter for more content like this throughout the day, and join our market outlook community that we created on Facebook. Another really easy way to tell us you want us to do the video again tomorrow is to let us know right here by clicking this heart. That will open up your tonight's Market Outlook tweet. Click that like button right there. You can also click this image. That takes you to your Facebook page. You can like tonight's Market Outlook post on our Facebook page. And then finally you can click that like button there. Those 3 clicks, again, tell us that you like the video, that you want us to keep going with it. Again, if you don't want us to do the video, you don't have to click any of these things. Alright, now let's get back to the charts. You see the long-term chart again. It's a little bit of context on a weekly chart. We did not close below that low point. Now, granted, it's to close below that low. That low will act as support on a closing basis. So that's by the end of this week. And of course, the 200-day moving average will also be important on a closing basis. So that's at 27.29 right now. As we head into the holiday, those are important levels to keep an eye on. So it'd be 2670 to the downside and 2730 essentially to the upside that you would have to need to clear again, like we did late on Friday last week, in order to be more bullish than bearish. And you can see the MACD is close to that death cross. The Dow is a lot less close. You can see still above its 200-day moving average. The Nasdaq is down below that long lower shadow, but not from a couple weeks ago, and then has its death cross as well. See, it's MACD, so the next week will show the pink shading. Now remember, you typically get a return move after a death cross. It might take a week or a few, but you typically get a return move, and that's to test where you keep coming down and start a bear market, or is that set the low point? And back here in early 16, it set the low point when you got the death cross, and we'll see if that ends up being the case again, like we're seeing right now with the death cross on the Russell 2000. So it's that next return move. When we get back and retest that 200-day moving average, does it retest it and bounce back down and now we're way to go just like all the other bear markets have started, or does it set the low point and then it starts a little bit longer of a leg to get that late cycle that we still haven't gotten yet? We haven't gotten that strong move higher in commodities after a peak in the stock market, which usually occurs at the end of bull markets. Alright, we look at the 3 green arrows. Of course, we got 3 red arrows now with the MACD showing that red arrow, which it didn't have until today, which means on the 3 line version, the MACD is crossed back below its 0 level. Again, similar to back here, right? Very, very similar pattern that we're seeing here. We ended up with a divergent low point there on the near-term line. So we'll see if what we look like here on this next little leg lower compared to this drop. After testing that 30-day moving average and coming back to, in fact, getting above it initially and then testing it and coming down. So getting above it initially, testing it, and then coming back down. So stochastics obviously looks like the intermediate line there coming into the lower half of the chart. Now we'll look at the intraday chart, and of course we ended up with a lower high at the very beginning of the day after a gap down, and a lower low. Had a little bit of a print down, much lower, even though the reality is we didn't get a low. There was like just a print down to that price. Most of the trading occurred up here, right about that 62% Fibonacci retracement level, which again is the bottom end of that retracement zone, so important to keep an eye. Last time we were here, we had that false kind of breakout move, then rallied up through it. So the dotted line is the 4-week midpoint, which won't change for a while. You can see both of these. There's still about a week or so to go before changing either to the upside or to the downside. The purple line, which is the open on the Hakinyashi candle on the weekly chart, you can see where it's at. It's basically at Friday's high point as well. We'd have to get through there. And then of course this is an important level. Last week's low point, and then last week's high point right around 277.5. So we're trading just inside the lower half of the chart, so it's bearish. That would be pink shading, but you still got some support here. Getting through this area, 267.5, would put us now down into where the next likely near-term bounce. Probably, we'll still get some near-term choppiness. In other words, we're probably not going to get a nice, pretty bullish near-term trend developing. If you take a look at the daily range today, let's go to SPY, and there was a little bit of a gap, not much of one, but we closed here at 273.73, and today's high was 273.38. So about a half a point, a little less than half a point, and the range was 5.3. So just under 6 points was the range today when you include the overnight trading. The volume at 102 million. So again, that's the kind of stuff that's like, it's just kind of hard to be too bearish when your volume is, down below the average, and your trading range is high, but it's not too much higher than the average, right? So, we're getting big moves to the upside and the downside because that's what the average is right now. That's what you get. It is above 2%, but it's not above 3%, which is, where, this line needs to get to tell us that we are starting more of a bear market, right? More of a recession type move. So that's why you see these big down days, you see big up days like we had on Thursday, and you think either we're really taking off to the upside or man, the world's going to end. But the reality is the averages are just high, so that's why we get these bigger moves. And from a volatility standpoint, volatility is still relatively high, up above, just a smidgen up above 20, but still in the process of kind of triangling, and right now forming a high lower than the last one as of right now. You can see too, not even getting above 1 on the ratio chart here, VIX to VXV. So that's why, again, today's move, as bearish as it seems on the surface, underlying not so bearish. In fact, I saw a tweet earlier today from Bespoke investment group that said that there was actually more new 52-week highs this week than new 52-week lows. So take that for what it's worth. So to summarize, we had a down day today. It was a little bit bigger than average, but recall the averages are getting bigger themselves. Not as much volume, not as big of a jump in volatility. Not a move to new lows except on the Nasdaq. But even then, not breaking below the lows from a couple weeks ago. So we're getting that near-term choppiness. We had this kind of deeper pullback that we had bounced up off of late last week because of how deep that pullback was. As we suggested earlier, late in Friday's video, that just means we're going to get near-term choppiness. We're not going to get the nice near-term bounce up to new highs yet. We're going to get a bounce up to a high, probably a pullback to a low before, and kind of potentially even triangle a little bit as with some of the levels I mentioned on Friday, 2800, 2750 in that area, before breaking out of any triangle to the upside, as you would expect, simply because of the seasonality. All right, so we'll see how that continues to be the case. But today's move hasn't altered that, just like Thursday's move hasn't altered the fact that things are volatile right now. We're not back up to, we haven't bounced up to these low volatility, moderated volatility yet that we expect to see. It hasn't happened yet, but we're also not breaking down to bear markets yet either. So don't get caught up in the binary mode of either financial media or what you see on social media. The markets are, when the volatility index and averages, trading ranges and volumes are this high, then you'll just get bigger moves. And people that are hurt the most by it are the ones that are either over leveraged because they have their positions individually are too big, or they are too one-sided in their active trading portfolio, say either making too many bullish trades or too many bearish trades without a good mixture of either, where they're just caught to one side, which is not what we've taught. In fact, in our options inventory class portfolio, this November expiration was the best one that we've had this year in the market since we started in April, right? So after the earlier part of the year where we had the big declines. So, we had our best month of the year during the time of the year where the markets were the most volatile. So, again, you have to have a good balance between the strategy you're trading. If you get too heavily one-sided and get caught on the wrong side, either too over-levered in one position, on individual positions, or in a total portfolio, that's when you hurt. And that's, of course, not what we teach market scholars. So do you agree with this assessment or not? There's a link popping out in the top right corner of your screen. Click that link up there and then hit the either agree or disagree. If you click disagree, scroll to the bottom, comment on what you see that suggests otherwise from what we talked about here today in terms of what our expectations are. Again, I know people have their opinions and they have their desires on where they want the markets to go, but if you're seeing something that would suggest something different from our posture, please share that with our community, not just obviously comments on what you want the market to do. Now let's take a look at what's driving price action today. You can see for the most part of the day, you had three asset classes that were above zero until the end. Crude oil rallied sharply off of its low point. It was down almost 3% early this morning. I remember it had that big capitulation decline and then rallied at the end of last week, and then gave up some of those gains early, finished the day with a 0.5% gain. So, take that for what it's worth. You can see long-term bonds were up, gold was up, and foreign bonds were up. High yield outpacing stocks, even though they were down and lagging behind treasuries. You can see preferred stocks falling back here. The dollar also down. Usually, again, severe sell-offs, you'll see gold and short-term bonds up here at the top, long-term bonds usually down here, and the dollar. You'll see the dollar up here at the top as well. So not as big of a sell-off, especially with crude oil finishing the day at the top end of this chart. But you can see on the other end, U.S. stocks getting hit the hardest. In fact, if you look from a foreign market perspective, you can see U.S. stocks had one of the bigger losses. There's IWM. And there's S&P. You have, like Sweden, Thailand, Argentina, Indonesia, some of these down here at the bottom. If you take a look at the foreign markets here, whoops, I think that was number 2. And let me get the, there we go. So you can see everything is green on this chart. It's not bullish, it's not completely bullish because you have a lot of red lines. Red lines mean we're below falling moving averages. Green lines mean we're above rising moving averages, and yellow means we'd be above a falling moving average. So we have some mostly red, and we have one red chart which happens to be the U.S. So it's kind of rare to see the U.S. being the weaker performer for most of this year. It's been the only green one with all the red. So everything else had down days today, but still have bullish postures. You can see weak, 25, 25, 23, 27, 40, 46, 21. So they're relatively weak, but you do have a strong posture in India. There's a 35 there. You also have China looking better, and they have the green moving averages. So, it's a slow rotation from what was really bearish to some lows being developed here. Of course, breaking to new 3-month lows, for across all of these, that's going to be our signal that we're getting the death crosses and we're making our run to the downside, especially without the long lower shadows in the weekly chart. But as of right now, it's not the case. We're kind of basing so far. And today it was a down day, but hasn't changed that narrative of the basing patterns quite yet. Here's the different asset classes on their own individual 3-month daily charts. There's your U.S. stocks, kind of your alternative classes, preferred stocks, dividend stocks, MLPs down, real estate outperforming, long-term bonds starting to rally, along with foreign bonds, municipal bonds, high-yield bonds still really struggling. Crude oil with all those clusters and all those consecutive down days, and there's your capitulation move. So far, this is a little bit of a dead cat bounce so far. Getting above that down day here where we got that cluster will be significant. If you take a look at like the weekly chart, we didn't quite get a cluster on the weekly chart. It came really close. The intermediate line was at 22. So didn't quite get the cluster, the oversold cluster like we had in early 2016. And if you take a look at the 50 200-day moving averages, we got the death cross on there. So are we setting the low point? We're going to retest now that we're this far below 200. Look for a bounce back up to that 200-day moving average. Are we going to retest? In this case, we never really did. We got retested the 50 before breaking down. Here we got up, got up above it, retested, and this kind of stayed down. And you can see some of the other patterns breaking up above there, retesting to the downside initially really quickly, and then taking off. So we're going to get a move back up, just like here. We got to move back up to the 200-day moving average. We didn't break back down again. So keep our eyes tuned. I think we had the capitulation low point, and now we're set for, at the very minimum, a retest of either the 50-day moving average or the 200-day moving average, which is more typical on crude oil. Again, not a typical, when the crude oil rises, you don't typically associate that with a bearish move in equities. Let's go back to this chart here. Long-term bonds is a little bit of a different story. If you were to take a look, at long-term bonds, let's go back to a daily chart, right here. You can see, there's this old high point right here that it needs to clear before a trend changes in long-term bonds. Of course, the opposite side of that would be the yields falling back below. And here, let me get rid of this. Fall back below 3.05%. So a little bit of a double top. You are clearing below that low point. You are back below that old high point here. Getting below this low, kind of getting below 3% will be an important reversal for the yields, and kind of would be a reflection of falling economic growth expectations. You can see the divergence highs at getting below that low point would signify a change in trend. Most likely would also suggest a pause in interest rate hikes going into next year. If we were to continue to break down and crude oil were to continue to break down. As you see, the 5-year forward inflation expectations have really come down to low points that we haven't seen, to lower low points, coming down from this kind of diversion high down to a lower low. So trending lower. The Fed needs to have falling in. Now, granted, we've had periods of time where interest rate have fallen, but not to lower lows any of these times. This would be kind of the first time you've fallen to lower lows. So that will be interesting to see how the impact that has on interest rate hike expectations going into next year, specifically into next March, where the next kind of live meeting, so to speak, the odds now at about 35% so here's where we are now. That would be the December hike. So we're down to like 35% odds that we'll get a rate hike in March. That's a significant drop from where we were above 50%. Like, that's the gray line. And then there's the no rate hike in March after December would be the red line. So you see how it's back up higher and making a strong run. In fact, the purple line is making a strong run up to new highs, which is no rate hike in December either. That's very unlikely. It's still well below 20%, but still you can kind of see here's December's rate hike odds, which were easily up above. So here is the purple line would be the odds for getting one. Easily still up above 60%, but was up above 80, and so now falling, and there's the odds for no December hike, still below 40. So we're not talking about there's still most likely odds that we'll get a rate hike in December, but you can see in March it's not the same story anymore. So things slowing down. Now remember, last time the Fed stopped raising rates, the market rallied for another year plus, and then the commodity prices rallied for another couple of years. before the stock market really hit the fan in terms of bear market recession in 2008, summer to fall of 2008, and then eventually bottoming in March of '09. Alright, now we look at the sector rotations, and you can see, of course, interest rate sensitive areas. Not everything was down today. Even financials, which would be the interest rate sensitive area on the other side of the equation, it outperformed and was actually up a little bit. Energy and materials outpacing the market, and along with industrials, with the weakness in the dollar today. And of course, your three biggest laggards are your technology, communication services, discretionary. So here is a discretionary popping down, and technology hitting new 3-month lows here, and communication services also sharply lower. So those are by far your biggest three losers. There's your safe haven areas up here above rising moving averages. Healthcare kind of moderating in the middle of its 3-month range, along with materials and financials. Industrials coming off of its lows, coming down a little bit, and energy more towards its lows here too. So some bullish sectors, some sectors that are looking more positive. Not a whole lot of green lines. There's only 3 of them. The rest of them are red or yellow, along with the S&P. So it's these 3 areas, XLC, XLY, XLK. Those are the 3 that, we don't necessarily expect them to lead the market, say, a year from now until a year from now. Even if we were bullish for the next year, because of the cycle, the economic cycle we're in, we expect materials and energy and industrials eventually to lead us more longer term. But these are the 3 areas that will most likely lead us on any bounce that we have. And right now, they are the 3 most bearish sectors, and that's what's putting pressure on the markets, not necessarily pushing it to new lows, because not everything is down. When the market's really bearish, you have 100% correlation, so we're not getting that. We're just getting weakness in specific areas, specifically those higher momentum, higher growth, higher beta type areas, and that hasn't bled through to everything quite yet. One stock in that technology area, among many that were down today, but really kind of had a down day itself, was PayPal. PayPal, had broken below 82.5 once before, but it was a kind of a fake out move and got right back up above it. Today's move, this time closing at the low, a lot more bear, and closing at the low in the lower part of the 4-week range as well, according to the stochastics, with average volume, a higher level of volume than what we've seen here during a lot of this kind of rollover. If you take a look at like the market forecast chart for PayPal, you can see a strongly oversold momentum line, near bearish posture. Excuse me. A bearish near-term high point now that it is falling below 50, and we have broken the new near-term low points. Look at other lines like the Bollinger Bands here. It's a relatively wide band, relatively. Had been shrinking during this kind of wedge, but breaking back down to the downside, similar to what you had initially before the wedge, and getting really close to the lower band. There's some volume down here, so it's not going to be easy to break down, but you also see there's some strong volume that we broke down below that's going to be up above it. That's going to be key around that 85 level. Remember that here in just a minute. And then, of course, if you look at the DMI, you can see the orange line crossing up above the blue and above 25 with this average volume, kind of a breakdown move. And if you look at the other indicators here, you have a red oscillator and a red arrow on the stochastic extreme, which is a bearish sign along with this. So pretty bearish move for the stock. Here's the long-term move. You can see breaking down below the 50-day moving average towards the 200-day, coming down from a divergence, heading down towards the divergent low point, the low point in between these long-term highs. And then finally the green arrow chart. We'll take a look at that one last, breaking below the 8-day moving average, the 8-day crossing below the 17-day, stochastics crossing below 50. So all bearish signs. Of course, the easiest higher probability bearish trade to make is to sell that 85 where there is volume resistance up there, and then buy the 87.5. You get a pretty decent odds of success, and you get a decent credit for a $2.50 wide spread. You need at least 58 cents, or a few pennies over that. And of course that break even is right, above that 85 level. So we'd have to reverse this breakdown back to the upside and get back up above these highs before you end up with a loss. That's about at 60 some odd dollars up above. So you have to get above 86 before we get a loss similar to what we're trying to get. And that would be our exit point to the downside. You can see if we were to go down, continue down here sharply, quickly, in a few bucks, we can try to get half of that, about 30 bucks out of that 60 gain, because you can see the first $30 is a lot quicker to get than the last $30 is. Eventually, as time passes, you can see it even gets quicker and quicker to get the first $30 move than it is the last $30 move. So if we can get that first $30 move quickly, then we can take it and move on to something else, to another trade. All right, well, that wraps us up for today. As usual, thank you very much for watching our market outlook tonight. Remember to catch us tomorrow. Follow or subscribe to our YouTube channel. Comment down below. Click the thumbs up icon. Let us know that you want us to do this again tomorrow. Follow me on Twitter for more content like this. Subscribe to our Market Outlook community that we've created on Facebook. Have a great rest of your evening, everybody, and we'll see you all tomorrow.